The recession indicator, designed to stay buried inside Moody's analytics, just went public in the worst possible way. On April 7th, 2026, it triggered. Every time this model has crossed its threshold in nearly 80 years, a recession followed. It has never been wrong. The model is called the Vicious Cycle Index. It just hit 48.6%. That number means the probability of recession within 12 months is now nearly a coin flip. Most people have never heard of it. This is what it sees, and why you should pay attention. So what exactly is the Vicious Cycle Index? It measures something deceptively simple: fear feeding on itself. When consumers lose confidence, they spend less. When spending drops, businesses cut jobs. When jobs disappear, confidence falls further. That is the vicious cycle. Mark Zandi designed this model to capture that self-reinforcing loop before it becomes unstoppable. It draws on consumer confidence surveys, weekly unemployment claims, corporate credit spreads, and business investment trends. What makes it different from the yield curve is precision. The yield curve has inverted without a recession following. It flashed in the late 1990s. No recession came. The Vicious Cycle Index did not trigger that year. It stayed quiet. It has only triggered when the feedback loop was already in motion, when fear had already begun eating into real activity. The track record stretches back to 1948. In 1973, the oil embargo sent energy prices surging. The Vicious Cycle Index triggered 4 months before the NBER officially declared a recession. For a line worker at a General Motors plant in Flint, that trigger meant the last paycheck before an 18-month layoff. In 1981, Paul Volcker raised interest rates to 20% to crush inflation. The index triggered again. The recession that followed was the deepest since the Great Depression. When the dot-com bubble burst in 2001, tech stocks lost $5 trillion. The index triggered months before most economists acknowledged the downturn. Then, in late 2007, the signal appeared. Lehman Brothers would not collapse for another 9 months, but credit spreads were widening. Confidence was cratering, and the vicious cycle was already spinning. The index saw what the headlines missed. Even the brief COVID recession registered. It triggered in March 2020, the same month the economy shut down. The shortest lead time on record, but still accurate. Every trigger, every recession, 0 false positives. When the Vicious Cycle Index triggers, what follows is not abstract. After a trigger, the S&P 500 has declined between 15 and 35% before reaching its bottom. For someone who retired in 2007 with a portfolio heavy in equities, that meant watching a lifetime of savings lose 1/3 of its value in under a year. Job losses in past triggered recessions have averaged 2.8 million in the first 12 months. The Fed has historically responded by cutting rates aggressively. In 2008, rates went from 5.25% to near zero in 16 months. In 2001, the Fed cut 11 times in a single year. But 2026 presents a complication. Tariff escalation and trade disruption are feeding into business uncertainty in ways that resemble 1973 more than 2008. That era called it stagflation. Slow growth combined with rising prices. A small business owner ordering inventory today faces the same impossible math. If this trigger reflects a stagflationary dynamic, rate cuts alone may not be enough. Cut rates and risk higher inflation. Hold rates and risk deeper recession. That is the trap the vicious cycle is designed to detect. So, who should you believe? Goldman Sachs estimates recession probability at 30%. Moody's model says 48.6. Goldman relies more heavily on financial market signals and earnings forecasts. Moody's model weights the behavioral spiral that financial models often undercount. For the indicator to reverse, trade tensions would need to de-escalate meaningfully, and consumer confidence would need to rebound before layoffs accelerate. Neither has happened yet. The historical pattern is stark. When the vicious cycle index triggers, a recession has followed within 18 months. Every time. That does not mean it is guaranteed this time, but the burden of proof has shifted. So here is the question for you. If this model has never been wrong, what would it take to convince you it is wrong this time?